Namaste and welcome to our MOOC Money, Mind and Markets, the Science of Financial Literacy, the week 6 Future of Finance. Today's topic is Decentralized Finance. In short, we call it as DeFi. So, today we are going to explore one of the most disruptive innovations in the modern finance, which is nothing but decentralized finance, also commonly known as DeFi. For decades, the financial system has been controlled by centralized intermediaries such as banks, stock exchanges, insurance companies, and payment processors. These institutions verify the transactions, hold the consumer funds, and enforce the financial contracts. However, the emergence of blockchain technology has created a new financial ecosystem wherein financial services operate without intermediaries. This new system is known as decentralized finance or DeFi. In simple terms, DeFi is a blockchain based financial system where transactions occur directly between the users using smart contracts instead of the traditional financial institutions. So, in one sense, the DeFi is an emerging financial system that uses the blockchain technology and cryptocurrencies to enable the direct financial transactions between individuals and businesses without intermediaries such as banks or stockbrokers. The traditional financial services rely more on the institutions like the banks, the stock exchanges, and payment networks. But here, DeFi attempts to remove these intermediaries and replace them with automated software called as a smart contracts, which are also executable on their own. In simple definition of DeFi is blockchain plus cryptocurrency plus financial applications, which gives the smart contracts. So, these elements allow the people, the investors, to borrow and lend money, trade assets, earn interest, send payments globally, remittances, all without relying on the traditional financial institutions. First of all, why DeFi has emerged? If you remember, the traditional financial systems are always been the centralized. For example, we have the banks which control the deposits and the lending. The exchanges, stock exchanges, that control the trading. The government regulates the financial access and supervises them. In contrast, DeFi promotes the peer-to-peer financial systems where the users interact directly with each other. So, the key goal of DeFi is to create an open, transparent, and accessible financial ecosystem. If you recall the evolution of the finance, let us briefly understand that the evolution of the financial system has been into the three phases. The first one being the traditional finance, where the bank holds the deposits, the payment network process, transactions, and the stock exchanges enable the trading. This is the first phase. And not only that, we also have the regulators to supervise the system. So, this system is centralized and institution controlled. Next comes the emergence of the cryptocurrencies. So, the launch of Bitcoin in 2009 introduced the concept of peer-to-peer digital money operating without the banks. Later, the blockchain platforms introduced programmable smart contracts, allowing the developers to build the financial applications directly on blockchain networks. This innovation led to the rise of decentralized finance, DeFi. So, decentralized finance refers to the financial services built on blockchain networks that operate without central intermediaries. So, instead of the banks or the brokers, DeFi platforms use the smart contracts. What are smart contracts? Smart contracts are self-executing programs stored on a blockchain that automatically enforce the agreement between the parties. For example, a loan can be issued automatically once collateral is deposited. interest payments are calculated automatically. So the uh, trades occur directly between the users without the brokers. This creates a trustless financial environment, meaning the users do not need to trust an intermediary because the system itself enforces the rules, self-executory rules. Then comes the third phase. Between 2016 and 2021, the DeFi experienced one of the fastest growth trajectories in the financial history. The key metric used to measure this growth is total value locked, which represents the amount of digital assets deposited in DeFi protocols. This growth was driven by smart contract innovation, decentralized exchanges, yield farming incentives, increasing the institutional interest. So, if this adoption continues at this pace, DeFi could become the core infrastructure layer for global finance by 2030. So, the explosive growth of decentralized finance, let us understand the timeline visualization. From the year 2016, we have the early blockchain finance experiments. Moving on to 2017, we have smart contract platforms that gained traction. 2018, the first DeFi lending protocols emerged. 2019, we have the DeFi total value crossing $500 million. And 2020, we have called the DeFi summer, rapid growth of decentralized exchanges. In 2021, TVL exceeds the 100 billion, and in 2022 we had the institutional interest and regulatory discussion, and 2025 we had the integration with the traditional financial services. And if you look at in 2030, the DeFi becomes a mainstream global financial layer. So in this way we can visualize the timeline of the DeFi. Now let us understand the key characteristics of the DeFi. DeFi platforms have several defining features. The first one being the decentralization. The control is distributed across a blockchain network rather than a single institution. Second feature is the transparency. All transactions are recorded on a public blockchain ledger, making them transparent and auditable. The third one is the permissionless access. Anyone with an internet connection and a digital wallet can access the DeFi services without the approval from the banks. The fourth feature is the programmability. Financial services are automated using these smart contracts which are self-executory. And the fifth one, global accessibility. DeFi eliminates the geographical restrictions, enabling the global participation. Now, let us understand the decentralized finance ecosystem. Let us visualize the DeFi not as a single product, but as an entire financial ecosystem operating without banks. As I said earlier, traditional finance has banks, exchanges, brokers, and insurers. The DeFi ecosystem also contains several interconnected layers that are built on blockchain technology. The layer 1 being the blockchain infrastructure. At the base of the ecosystem lies the blockchain networks. How blockchain powers the DeFi? This is a question. A blockchain is a distributed digital ledger that records transactions across the multiple computers. How does it work? The transactions are recorded in blocks, and the blocks are verified through automated process. Each block links to the previous block, and this becomes a chain. The chain becomes permanent and secure because previous blocks cannot easily be altered. And the blockchain networks are highly secure and transparent, and they have a public key and a private key. This has to match, so that makes a blockchain. So these networks provide the distributed ledger technology, we call it as a DLT, transaction verification, the security and immutability. So we have examples of infrastructure networks like Ethereum, Solana, and Avalanche. So think of this layer as a financial highway where all transactions revolve. Then comes the digital wallets. Users can access the DeFi through the digital wallets. A wallet allows the users to store cryptocurrency, send and receive digital assets, interact with DeFi applications. So each wallet contains a private key which acts like a password that proves the ownership of the cryptocurrency. The important point is the transactions do not reveal the personal identity but can still be traced to the blockchain. Next comes the second layer. We call them as smart contracts. The second layer consists of the smart contracts. Smart contracts are automated financial agreements written as code. They perform functions such as executing trades, issuing loans, managing collateral, distributing the interest payments. This replaces the traditional role of the bank officers, the brokers, and the clearing houses. And next comes the layer 3, the core DeFi applications. So DeFi applications are the programs that connect users to the blockchain networks. They allow the users to perform financial activities such as borrowing money, lending assets, trading cryptocurrencies, investing in digital assets. These applications run on smart contracts which automatically execute the financial transactions. So without these apps, users would need to interact with blockchain systems directly using programming commands. Next comes the smart contracts. What are smart contracts? Smart contracts are the financial services applications. So these include the decentralized exchanges, platforms that allow the users to trade cryptocurrencies directly without the intermediaries. And lending platforms. Users can lend the digital assets and earn interest while borrowers provide the collateral. We also have the stable coins. Digital currencies that maintain stable value, often linked to fiat currencies like the US dollar. And then we have the liquidity pools. Pools of digital assets provided by users that enable trading and lending activities. So these services replicate the traditional banking products but operate through code. And the layer 4 is the DeFi users. At the top of the ecosystem are the users. So the participants are the retail investors, the governments, the crypto traders, the institutional investors, the developers. All they need is the internet access. Okay, so internet access, a digital wallet, and the cryptocurrency assets. This creates a permissionless financial environment. So at the end, we can say that if you look at the entire spectrum of DeFi ecosystem, DeFi essentially rebuilds the entire financial system on blockchain infrastructure, replacing the intermediaries with automated smart contracts. That's what DeFi is all about. Now let us understand the primary objectives of the DeFi. The accessibility. Anyone in the worldwide can access the financial services without bank approval. Lower costs. So the users can negotiate directly, reducing the intermediary fee. Then comes the transparency. All transactions are visible on blockchain networks. Then there is financial autonomy. Users maintain the full control over their digital assets. Now let us understand the steps to engage with the DeFi. If someone wants to use the DeFi, they typically follow these steps. The first step being the research. Understand different DeFi platforms and services. Do your research properly. And then create a digital wallet. Example like crypto wallets that are used to store the digital assets. Step 3 is purchase the cryptocurrency. Buy cryptocurrency through a crypto exchange. And fourth step is to choose a DeFi application. Select the platform for services like lending or trading. And the step 5 is to connect the wallet to the application. So use this wallet to interact with the DeFi services. And this is how the DeFi works. To understand it with a real example, one well-known DeFi platform is Aave. Aave is a decentralized liquidity protocol where users can deposit the cryptocurrency, earn interest on deposits, and borrow assets by providing collateral. So the participants can act as liquidity providers by supplying funds to the system. The borrowers access funds for investment or it could be for trading purposes. Right? This is how it works. And what are the major DeFi services? DeFi offers several financial services similar to our conventional traditional banking services. One of them is decentralized lending. Users can borrow or lend cryptocurrency assets without banks. For example, a borrower deposits crypto as collateral. A smart contract issues a loan. So, interest is calculated automatically. This creates a peer-to-peer lending ecosystem. Second one, decentralized exchange, DEX we call them. Like how stock exchanges, traditional exchanges require intermediaries to match the demand and supply, the buyers and sellers. In DeFi, decentralized exchanges allow direct crypto trading using the liquidity pools and automated algorithms. The key features being there are no brokers, no centralized custody of funds. Not only that, it enables the faster global transactions. Next comes the stable coins. Stable coins, as we said earlier, the cryptocurrencies designed to maintain stable value, usually linked to fiat currencies such as the US dollar. They also play a crucial role in DeFi by reducing the price volatility. Yield farming. Yield farming allows the users to earn returns by providing liquidity in the DeFi platforms. So, users deposit assets into liquidity pools and receive rewards in the form of tokens or interest. Next comes the decentralized insurance. DeFi platforms also offer insurance products that protect users against risks such as smart contract failures or hacking incidents. Prediction markets. Another example, platform allows the users to place bets on future events. Example, we have the poly market. And not only that, we have NFTs, non-fungible tokens. DeFi ecosystems also interact with markets for non-fungible tokens that represents the ownership of the digital items. Now, let us understand what is the hype and reality in DeFi. Despite rapid growth, DeFi represents a very small portion of global financial assets. Less than 1% of global money is tied to cryptocurrency and DeFi. So, much of the growth has been influenced by the investor speculation, the media hype, and the rapid price volatility. The learners, the students, investors must approach DeFi with critical analysis and caution. And then we have something called as a crypto winters. A crypto winter is a period of prolonged decline in cryptocurrency prices. For example, the major crypto winter occurred between 2022 and 2023 when billions of dollars in crypto value were lost. So, these cycles show that cryptocurrency markets can be extremely volatile. Now, let us understand the advantages of DeFi. As we said earlier too, the DeFi offers several benefits compared to the traditional finance. The first one being the financial inclusion, where millions of people can have the accessibility, affordability and the adequacy of the banking services to participate in financial activities using the smartphone and the internet connection. Not only that, it reduces the costs by eliminating the intermediaries, transaction fee and operational costs. So, DeFi enables the faster transactions. Transactions are processed on the blockchain networks without physical or manual verification. So, it is very fast process. Then comes the transparency. All financial activities are recorded in a public ledger, reducing the fraud and the manipulation. Now, let us understand the risks and the challenges of DeFi. Despite its advantages, DeFi also faces several risks. The smart contract vulnerabilities, the errors in the smart contract code can lead to the financial losses. As usual, we will have the cyber security risks. The DeFi platforms are frequent targets for the hackers. Moreover, there is an important feature which is the regulatory uncertainty. Many governments are still developing the regulations for decentralized financial systems, where some of them have the sandbox systems. Next comes the market volatility. Cryptocurrency prices fluctuate significantly that will affect the collateral value as well as the investment returns. Most importantly, the challenge is the consumer protection, lack of consumer protection. Unlike banks, most DeFi platforms do not provide deposit insurance or do have regulatory safeguards. Now, once again, let us understand the real world impact of the DeFi. DeFi has the potential to reshape global finance in several ways by disrupting the traditional banking services, enabling the borderless financial transactions, creating new investment opportunities, increasing the financial inclusion in developing economies. So many financial institutions have explored the blockchain-based financial services, reflecting that DeFi is influencing the future structure of the global finance. Let us have a small discussion on DeFi versus traditional banking comparison network. To understand the disruptive power of DeFi, we must compare it with the traditional banking system that has dominated finance for centuries together. Let us analyze the differences across 5 key dimensions. The first one being control and governance. Traditional banking controlled by the centralized institutions, whereas the DeFi under decisions made by the bank, management and the regulators. Whereas the DeFi operates through decentralized blockchain networks. Governance often handled by token holders through voting. This represents a shift from institutional authority to community governance. Next comes access to the financial services. Traditional banking requires a lot of documentation and identity verification (KYC) norms. Not only that, it also has a limited access for unbanked population. But whereas DeFi is open to anyone with internet access and there is no centralized approval required. So this creates a global and inclusive financial ecosystem. Then comes the transaction processing. Traditional banking involves transactions with multiple intermediaries such as banks, payment networks, the clearing houses. This increases the cost as well as the delays. Whereas in DeFi, the transaction occurs peer-to-peer using the smart contracts. So the settlement can occur within minutes instead of the days. Next comes the transparency. Traditional banking, financial operations are largely transparent to the customers, whereas in DeFi, all transactions are recorded on public blockchain ledgers, making them fully transparent and auditable. And the most important thing is the risk and the regulation. In the traditional banking, we have strong regulatory frameworks. We have like deposit insurance protection of 5 lakhs for customer, central bank oversight. Whereas in DeFi, there is a limited regulatory oversight, higher technological risk, and not only that, we also have the smart contract vulnerabilities. That is why regulators worldwide are now studying how to govern the decentralized financial systems. Yes, the future of finance is more of a hybrid financial systems, whereas we can see the strategic fintech playing an important role. Now, an important question for the future financial professionals. Will DeFi replace the banks? The answer is probably not. Instead, the future financial system is likely to be a hybrid model combining the traditional finance and decentralized finance. And the three possible future models which we can think of are the model 1, wherein traditional finance dominance. So, banks remain dominant but adopt blockchain technology internally. For example, we have the digital asset custody services, blockchain payment systems. Second model is fully decentralized financial systems. In this scenario, the individuals control their financial assets directly and the smart contracts replace many banking services. However, challenges such as regulation and cybersecurity remain same. Third one is model 3, which speaks about the hybrid financial ecosystem. This is the most likely scenario. In this model, the banks provide regulatory compliance and security, and the DeFi platforms provide innovation as well as automation. This creates the integrated financial services model. Now, let us understand one small real world example. Many global banks are already experimenting with blockchain settlements, digital asset trading, tokenized securities. This shows that traditional finance is adopting rather than resisting the decentralized innovation. So, the final insight is for the next generation of finance professionals, understanding both traditional banking and decentralized finance will be the essential point. So, those who can navigate both systems will shape the future architecture of global finance. Now, reflect. Is DeFi worth it? DeFi can offer opportunities such as yield framing returns, liquidity rewards, trading profits. However, the risks are equally significant. So, experts suggest that only funds one can afford to lose should be invested in DeFi. For long-term retirement investments, traditional diversified portfolios may be safer rather than the DeFi. So, the thoughts on future of finance will conclude this session. DeFi is still in its early stage of development. In the future, we may see integration between the banks and the blockchain systems and the regulatory frameworks for the DeFi platforms, institutional adoption of blockchain finance. So, the traditional financial systems are likely to adopt and incorporate the blockchain technology rather than disappear completely, right? So, the future of DeFi will likely involve integration between the individual finance, traditional finance and decentralized systems. The possible developments include control CBDC, central bank digital currencies, regulated DeFi platforms, institutional adoption of blockchain finance, and the hybrid financial systems combining the banks and decentralized networks. As technology evolves, DeFi may become a core component of the next generation financial system. To conclude, decentralized finance represents a fundamental shift in how financial services are created, accessed, and managed. DeFi is a blockchain based financial ecosystem that enables peer-to-peer transactions without banks. So, if you recall, the key features of the blockchain technology, the smart contracts, and the cryptocurrency wallets. Most importantly, with the decentralized applications. While promising, DeFi still faces security, regulatory, and volatility challenges. So, by leveraging the blockchain technology and smart contracts, DeFi eliminates the intermediaries and enables a more open and accessible financial ecosystem. However, challenges such as regulation, Security risk and market volatility must be addressed before we can achieve widespread adoption. Therefore, the future of finance may not be entirely decentralized or centralized, but rather a hybrid model combining both systems. Are you fit? Finance is fitness. Earn, save, invest, retire. Happy learning!